Are you ready to revolutionize your relationship with money? Welcome to the Finding Financial Freedom podcast with the Frugal Physician, where Dr. Disha Spath will be your companion on this exciting financial adventure. Get ready to conquer debt, build wealth, and embrace a mindful spending lifestyle that will empower you to live life on your own terms.
Welcome to the Finding Financial Freedom podcast with the Frugal Physician, the podcast designed to empower healthcare professionals with the knowledge they need to achieve true financial independence. I'm your host, Dr. Disha Spath, and today we have a special guest on the show. Joining us is Dr. Tarang Patel. Dr. Patel is a diagnostic radiologist practicing in Phoenix, Arizona, and is the host of the famous Dr. Money Matters podcast, which discusses financial topics and other issues impacting physicians and healthcare professionals. He trained professionally at Mayo Clinic and New York Presbyterian Hospital Cornell. Dr. Patel served as a medical officer in the U.S. Air Force prior to moving to Arizona. His interest in finance comes from reading and hearing many stories of physicians who have had financial issues despite many years of well above average income. As the next generation of physicians enter practice, they are burdened by increased loan burdens, increased training length, and decreased self-employment opportunities. Therefore, good financial education and habits become paramount. Dr. Patel wants to do his part to help educate the next generation of physicians. Welcome, Dr. Patel.
Thank you. Thanks for having me.
It's so nice to have you. We used to do a podcast together back in the day, and it's like a reunion.
Gosh, that was right before COVID.
Was it really? Oh my gosh, it's been 3 years. Where does the time go?
I know. Crazy.
I mean, but you've still stayed in this space. I really enjoy your group because you're kind of a skeptic in the financial field of, everything out there. And I like that. I think that's a very important voice to be heard because, we really need to look at everything, including all the content that all of us are putting out in a more scrutinous light, just to make sure that it passed the stress test. So I'm glad you're here to share your perspective. I think you do a really good job of protecting doctors from financial mistakes that might be made, whether it's in the regular realm or even the realm of social media. So let's get into it. Can you provide us an overview of the financial challenges that doctors commonly face in their careers?
I think doctors, historically have faced similar challenges to now in terms of they don't have much educational training in terms of finances. They're generally relatively zero income or low income, and then they come out, and unless their family provides them with finances or financial education, they come out of training without any significant knowledge, and then they're kind of put out in the workplace without anything, and all of a sudden they're making significant money, and they don't really have any great tools or knowledge in how to deal with that. It's not too dissimilar from a professional athlete. Obviously, the amount is different, and your age is generally a little bit higher when you start making the money, but you go from very little to no income to pretty significant income. And you've got a target from the financial industry on your back saying, hey, look at these young doctors. They're making a lot of money. They don't have a lot of expertise in this particular area, and they're trustworthy. Doctors tend to trust other so-called professionals because we trust each other and we expect our patients trust us, and we kind of have that trust in other professionals. And maybe we shouldn't.
Mm-hmm. That's interesting. Tell us about your experiences with the financial industry and your journey as a physician.
I've always been a little bit of a skeptic. When I got out of the military, I wasn't able to get the disability insurance and everything that you're supposed to get when you're first in. And so I had to wait till after my active duty time. So I called up a few advisors, including someone that's friends of the family, and they tried to sell me on not just disability, but all the other typical stories that you hear about whole life insurance and all that stuff. And being a little bit of a skeptic and having access to Google, I started looking up things, and I quickly got to the Boggleheads website and the forum, and I started learning about all these things. And I'm like, oh, wow, why would anyone pay for these things if they don't have to? So I went into more depth into that, and I just went down the rabbit hole and kind of learned all those things. So I was able to avoid some of those mistakes that many of our colleagues were not able to avoid.
That's awesome.
Yeah, and I was lucky that the group that I worked with, we were in the same age financially and all kind of went down the same path. So we all made relatively intelligent financial decisions. So it was kind of positive reinforcement.
Well, tell us a little bit then about the specific investment products that doctors should be cautious of when they're approached by a financial industry representative.
Yeah, I think what you just said right there, financial industry representative, is a good way of describing it because they're not the same thing. There's so many designations, and we hear the term financial advisor, and we don't really know what that means. These days, when you say doctor, you generally know what they mean, but there's also variations there too. But in financial advisory terms, you really don't know. Are they a CFP, certified financial planner? Are they a CFA, chartered financial accountant? Are they a insurance salesman, or are they just someone who is designated by a financial service company to be allowed to sell certain products? And there's very differing levels of expertise required for those things. And there's also a varying amount of ethics amongst those people who sell those products. So the products tend to be, when you first get out, like I said, I was looking for disability insurance, looking for life insurance, and there's all kinds of products that are being sold to you. So there are products that you should have, and there are products that are sold to you. Life insurance is a prime example. Term life insurance, and I'm sure your audience knows this, is generally the cheapest, most cost-effective, and it's virtually a commodity amongst the highly rated insurance companies. There's little difference between them in terms of company A, company B, as long as they have high ratings. When your advisor, quote unquote, starts indicating that maybe you should look at this investment product that has insurance in it, that's when your red flag should go up. And they know that if you're paying $200 or $300 a month for a $2 million life policy, but you're making $3,000 to $6,000 a month, they could probably get you for another $1,000 and call it an investment.
Mm-hmm.
And the main thing is, I don't like people, and I know you've educated your listeners to not treat insurance as an investment. That's number one. And I think that's prime. If you could avoid that mistake, you're well ahead of a lot of colleagues.
Yeah, whole life insurance salesmen. And this has become really popular on TikTok recently. I don't know. They seem to have found a new group of people that are willing to sell it, but they're just brainwashed. I mean, a lot of these salespeople don't even know how much they're screwing you. They do know that they get a huge commission from it. But yeah, the amount of fees, the amount of commissions, it's just sad to me to see that being sold widely, even though there have been so many of us spreading this message, right? And I hope doctors that listen to this don't fall for it. But there are very, very few cases where putting money in whole life insurance might make sense, but that's at the very, very top income, very high net worth people that need to hide some of their money in non-taxable areas. But that's not for the regular doctor.
Yeah, when you're coming out of training, you're very unlikely to be in that position.
Right, exactly. All right. So what are any pearls that you could share with us? How can doctors differentiate between legitimate investment opportunities and potential scams? Because a lot of the potential scams do come at us from everywhere.
A key indicator for that is there's that old saying that if they're talking about it in the doctor's lounge, it's probably not the best opportunity. Doctor's lounge today is social media. If they're pitching investments in various Facebook groups or in various online portals or whatever, you should be already just a bit skeptical. I'm not saying they're all bad. I'm just saying that you should be a little bit more skeptical than you would be if you were buying an ETF or something like that. These private real estate funds, these private investment opportunities, they are so opaque with their fees, with performance, with abilities to take your money out, that generally, if they're marketing to you as the individual physician, you should be wondering, if there's such a good opportunity, why didn't a large investment fund do this already? Or this group of people that are marketing to you, why aren't they putting their own money in, or at least a significant portion of their money in? Again, it's not all bad, but we've seen, and I've been pretty vocal in my Facebook group about multifamily housing as an example of this over the last few years, that there's been just so many physicians or their spouses getting into the space and using the era of low debt to become, these multifamily syndicators. And most of them don't have any significant track record. Some of them do, most of them do not. And almost none of them have been through a full cycle, the downturn and the upturn, or the upturn and the downturn. And so I tend to look at the track record of the operators. I tend to look at their assumptions that, hey, if you buy this property now, in 2-3 years, we'll be able to flip it for 2x. And meanwhile, you'll get all these tax benefits and cash flow. You really got to say, okay, what is the likelihood that something will appreciate that much in such a short time? It did happen. From 2019 to 2021, it was incredible. And if you were in those, it's amazing. But it wasn't a long-term thing, because what ended up happening was people sold those things, and either they had to take the tax hit, which of course these syndicators tell you, oh, you can then reinvest into one of our existing properties and you can defer the tax. But then they're now facing issues on that side, because as we know, the investing environment has changed significantly. I think we're going to see a lot of downturn still to continue, and a lot of these syndicators going to be basically selling properties either in distress or really not even coming close to what they indicated in their offering memorandums.
I was going to say, how the high interest rates affected these syndicators. Have you seen a lot more capital calls recently?
There have been a number of capital calls. There have been a lot of people who, even more than the capital calls, have not paid out what they were supposed to do in terms of their distribution, and they're holding that. Now, technically, that's not a capital call, and they're saying that they're going to count that, and later on they'll make you whole. But if you're not getting back your money that you anticipated getting, and that was one of your purposes for investing, was to get a cash distribution, you're not super thrilled, and it's functionally a capital call, even though technically it's not. There's still some of those who are in denial that they're not doing capital calls, and I can see it. I get messages all the time from people who are like, yeah, these are not performing even close. And if they're not requiring a capital call, they're going to be short.
So let's back up a little bit and explain what a syndication is to our audience. Would you mind just breaking it down, just the basics of how these work?
So a syndication basically is a pooling together of capital. So a GP, general partner, will find, let's say, an apartment building or any kind of investment opportunity. And let's say they need $10 million to buy this property. They will put in some money themselves, and that varies from investment to investment. And then they will try to pool together a certain amount. So let's say if it's a property, they need to borrow $7.5 million from the bank. They need to put together $2.5 million, 25%. Now it's a little bit higher, but let's just say they need to put together $2.5 million. They put in $100,000. They need to raise $2.4 million from a group of people. They will then look to their community, their social media, whatever, accredited investors who qualify for certain income levels and positions are prime in that market. And they will try to put together opportunities and say, okay, if you give us $100,000 for this investment, we will pool together with the other people, and then we can buy this property. And then hopefully that property appreciates. And if it doesn't, we still get cash flow from the rental income, and there are tax benefits. So that's the syndication, the people who put together the capital, the amount to then come up with a down payment to then borrow the rest. Mm-hmm. So it's a leveraged investment, meaning that now you're borrowing 70 to 75% from the bank, and then you will get the returns. Mm-hmm. And the general partner manages the investment, so they get a fee for managing the investment. And then if the property does appreciate or it's able to sell for more, a certain amount goes to the people who put in the money, and then a certain amount on top usually goes to the general partners.
So in theory, it sounds like a good way to up your game. What are some of the dangers of investing in syndications? And you alluded to earlier several of them, but just can you lay them out for us?
Its model's been around forever, so it's not a new thing. It's just that the dangers are, the general partners don't have enough experience. They underestimate what the investment opportunity is going to cost, the upside, the downside, any risks, the length of time that this investment will take to actually play out. Mm-hmm. The big risks that I've seen over the last few years are, it's pretty easy to put together a pitch deck for an investment opportunity. There are services online, like let's say there's a multifamily building in your city. You take a few pictures, a simple Word document or whatever. There's a lot of online services that you can just take that and then have them gloss it up and send it, and now it looks like, oh, wow, this looks like a very professional document. These people must have experience at what they're doing. They didn't do any of that work. They just outsourced that bit. And the same thing applies to the management of the property, the financial stuff, the investor relations, all that stuff is being outsourced in different ways. And a lot of these people don't have the level of expertise that's needed. Generally, the syndicators that I'm worried about are the ones who don't take it on as a full-time job and are still working as physicians, working as whatever other professions they have, and they're not really tied in. And then the other big red flag is how much did they put in? A lot of times they don't put in that much. They say, oh, we're investing, but I noticed that physicians, like I said at the earlier part, we're very trusting, and especially of other physicians. And we're like, okay, well, they put some money in, they're managing it, seems pretty good. And over the last few years, things worked out really well, so it must continue. As people start being aware now, those times have ended. The ramifications haven't fully borne out yet, but they are coming.
Right. Past performance does not guarantee future results. Always good to remember that. So have you invested in any syndications yourself?
I have. I did a couple before the pandemic, and I did a small amount in 2 syndications that were run by the same firm. And I wanted to see how they would pan out.
Mm-hmm.
They didn't really pan out that great. The one panned out decent, one was not very good, but it gave me an idea that I'm like, okay, it gave me some insight into their documents so I can analyze it. And it gave me the knowledge that I'm not going to be investing with that group or their GPs any further. But it gave me a little bit of knowledge to learn.
And how do you go about researching a general partner? Like how much experience they have?
That's a good point. I talk to them. Don't just look at their websites or their bio that they send you. I talk to them, and honestly, it's a bit ageist, but I find that the ones who have been in this space for the last 5 to 6 years or 7 years only have only, like I said, seen the upcycle. And they tend to be very optimistic, which is great, but I don't think that they're realistic. I tend to discount some of them now. I didn't initially, but now I tend to discount them. And I think, unfortunately, those are the ones that, at least that I'm seeing, that are in trouble. I'll give you an example of one that was pitched as a co-investment opportunity. I'm not going to mention the name. It was a group that young, bright general partners, they pitched and they built up almost $7 billion portfolio of properties in Phoenix and in Texas and in Vegas. And they grew incredibly fast and they were excellent at what they did, but they started pretty recent. And it was incredible the amount of money that they were able to raise, and they sold properties so quickly and they made a lot of money, but that gave them a quote unquote track record. But it turned out that they were basically selling properties at such a high price, but then they were forced to then buy new properties at a high price because they made the market. And so they are now in trouble, and it's been all over the news now, but it basically, it was working until it doesn't work. And it's that theory of that old myth of Icarus flying too close to the sun. It's great. And then right at the top, you get in trouble. But that was just one example. There's a lot of people. I get calls and messages from a lot of people because Phoenix seems to be an epicenter of this stuff, that a lot of people are in trouble with their investments here. Hopefully it turns out okay.
Oh, I hope so too. I mean, it's tough to see people losing money and making poor decisions, but how can we educate ourselves to avoid these traps where the financial industry might be trying to sell us something or investing in something that's super risky or just not well-founded, like some of the examples that you just mentioned? How can we educate ourselves to not make those mistakes?
So I think there's education. You can learn about like the investors, you can learn about the markets, but most of it comes down to investing psychology. You're never going to be perfect in investing. Warren Buffett's not perfect in investing. None of these big time investors are perfect. But you have to have the fortitude. If you take a loss, learn from that. And you have to realize, like, why am I investing? Am I trying to hit a home run? Like those people who bought crypto at 10 cents, it was a relatively low risk for them if they bought Bitcoin in 2012, right? If they spent $1,000 on Bitcoin and they didn't, it was $1,000. I mean, you don't want to lose money, but it was low risk. But if they bought it when Bitcoin was 60,000, the same amount, what are they trying to do? Are they trying to 10x their money? Are they trying to just grow slow? So you have to figure out what you're trying to do. And again, for most physicians, you don't have to go crazy. If you do conservative investments in just basic things, you'll do fine. Yeah, you may not, get there as quick as the person who bought the crypto or the person who runs these multifamily investing. That's fine. You may not have multiple properties and be able to travel the world, but that's okay. You still be able to do those things, but you may not be able to fly first class or whatever. That's fine. But you got to figure out, what are you trying to do? If you're trying to do those things, you'll have to take more risk, certainly. If you're trying to just keep your capital, you don't have to take risk. You'll do great. But I think that's the main thing, is look at what you're trying to accomplish before you put in money anywhere. And then start looking at the motivations of the people who you think about their motivations. Why are they trying to get me into this investment? Mm-hmm. It's not always bad, but those are the things I don't think people ask enough questions about.
Right. So we've talked about syndications. We've talked about whole life insurance. Is there any other product that you see being sold to physicians that we really should kind of research that might be high risk?
I mean, over the last couple of years, it's not an investment product, but I saw a lot of physicians being marketed to take courses or go to conferences put on by other physicians about whatever topic it may be, whether it's multifamily investing, real estate in general, short-term rentals, stocks, you name it. I don't have comments on those individual courses, but I don't think you need any of those things. I think you can get the same information from books and learn it at your own pace. You can get a lot of the information however you want to do it. Now, if those courses work for you, that's great. And I've had people reach out to me saying, you know what, those courses kind of put me in a mode to go ahead and do it. Awesome. I don't have any problem with that. I just don't think that most people need that, but it feels like, a lot of people do.
Yeah, I can definitely see that. I mean, having been a part of a lot of these things myself, I learned from books and podcasts, completely free sources. I did not take any courses, but I was also super wanting to know all of this stuff and wanting to understand it and super focused on it. Whereas if someone really wants to learn finance, but is not as motivated, a structured environment can give them that format of, class that we're used to of being, professional students, that it can help them learn and integrate that information better into their own lives, and then provide them with the community that they need in order to, and then the support they need to take that next step and, open that account and start investing. So I can certainly see both sides of that equation. And I agree that not everyone needs all of that extra, and you could get it at a much lower price point.
I think as soon as they label a course that's for doctors, all of a sudden, for some reason, doctors love that and they're willing to pay extra. Do you really need CME for a course that's on real estate investing? No, you don't. You can still go to it without that, Yeah, I mean, don't get me wrong. If you can get someone else to pay for it or you can write it off, I understand that mindset. You and I have met a lot of the people in the physician financial space, and you're one of the more genuine people in that space.
Thank you.
Some of them they have a good heart and they want to help doctors. I think most of them want to help doctors. I don't view doctors as a product. And I can't say that for a lot of my colleagues.
Yeah, it's true. Doctors as a product. That's kind of the theme of this podcast and interview with you is, we have to be aware of the fact that we're a very high value audience for a lot of people, including other doctors. So we have to, do our due diligence in any investment and make sure that we know what we're investing our money into and make sure it's worth, the value is there for us. And only we can understand that because only we know what we need in order to take the next step. So what if doctors actually find themselves being victim of actual financial exploitation? Say their advisor did something really bad with their money, or, there have been instances where there's been theft. Are there any institutions protecting us? Is there anywhere we can go and seek help?
There are. I mean, I think you can go to, depending on what it is, whether it's an insurance related issue, whether it's a financial advisor that does brokerage accounts. There are regulatory agencies for these entities, right? You can complain to your state insurance company board, or I think there's a national clearinghouse for SEC. The Securities Exchange Commission has a registry of financial advisors who have a certain amount of assets under there. So you can report things to them. My main thing would be if you suspect that, though, and you're a physician, the first thing, just talk to an attorney. And honestly, we don't like to get attorneys involved as physicians, but in these kind of scenarios, because you're probably talking about, if you lose $10,000 in a syndication, okay, you're not going to get that back. and you just take it as a lesson learned, and of course it may be worth more to a pediatrician coming out of training than it is to a plastic surgeon who's been out there for 20 years. But if you're talking about, you're 65 and all of a sudden you realize that your financial advisor has been siphoning off money from your retirement accounts, that's a massive thing. And the best thing you can do is, I think, talk to an attorney, because they're going to have avenues for recourse that you wouldn't. And yeah, you can report them to these organizations, and certainly the attorney would do those kind of things as well. But I think at that point, when it's higher sums of money, you'll get more things done if you are legally represented.
That's good advice.
Yeah, I think that's the main thing. And I did a podcast years ago on disability insurance, and not just buying disability insurance, but for those people who are claiming disability insurance. And I had a disability attorney on there, and he's like, listen, it's all fun and easy when they want to sell you the disability insurance. But if you actually need the disability insurance, you can be sure that they're going to make it tough. And so you need an attorney on that side. So, that it just kind of got me thinking that, unfortunately, we're going to need attorneys for a lot of things if we were not treated properly.
Yeah, having a good network of attorneys at your fingertips is very, very key as a physician. We generally don't like the lawyering profession.
Right.
I mean, there's a reason they're there, and it's for these kind of things, and they can be on our side too. So thank you, Tarang. We've gone over so many great points here. Are there any last nuggets of wisdom you would like to leave our audience with?
The main thing is just know why you're getting into an investment. I think I made that point earlier, and know your investment threshold. So if you're a physician coming out of training and you're like 5 years in and you're like, this sucks, I want to get out, and you're going to need to hit home runs in investing, you're doing a different thing than someone who's like, I just want to make sure I have a solid base for retirement and I can, put in a certain amount and I still want to live a reasonable life while I'm working, but I'm going to anticipate working for 30 years. So know your basis, why you're doing an investment psychologically. And then the other thing, and I'll send you the link, is there's a great YouTube video. Charlie Munger, Warren Buffett's partner, has this really good video on a talk that he gave to law students at the University of Michigan years ago about how we are influenced by everything. And it's called The Psychology of Investing in that sense. But I'll send you the link. And it's a really great way to know that you're influenced a lot in ways that you don't think. That's why I said more, it's about the psychology than it is about learning about each individual investment opportunity. That'll protect you a lot more than trying to research every single opportunity.
That's great. I can't wait to watch that video, and we'll go ahead and link it in the show notes of this episode as well. All right. Well, it's been such a pleasure having you on, Tarang. Thank you again for coming and sharing your wisdom with our audience, and I hope we can have you back at some point.
Great. Glad to see you're doing so well. Thank you for having me.
Thank you, Dr. Patel, for gracing us with your insights into the intersection of medicine and finance. Your expertise has shed light on many of the common financial errors that physicians can make in the financial industry. To connect with Dr. Tarang Patel, follow him on Twitter at Dr. Money Matters, and make sure you tune into his podcast, Dr. Money Matters, for more in-depth discussions. As we conclude this episode of Finding Financial Freedom with the Frugal Physician, remember that your financial journey matters, and we're here to guide you towards making informed decisions for a secure future. Stay tuned for more enlightening conversations, and until next time, take charge of your financial well-being and continue on the path to financial freedom. Thanks so much for joining us. We'll see you next time.
The content shared on this podcast should not be taken as individualized financial advice. We are here to share our knowledge and experiences, but it is crucial to consult with professionals such as accountants, financial advisors, or attorneys who can provide personalized guidance based on your specific needs.